Hope you had a great Labor Day. There's some very interesting things happening in the news. And let me start with Bloomberg News that has an article in today's paper. Here's why Morgan Stanley says S&P 500 may near 3,000. Let's get into this. The Standard & Poor's 500 index isn't really over, and the gauge could jump 50% more by 2020 as the U.S. economic recovery heads for a record winning streak, according to Morgan Stanley. We look at the world's largest economy, that would be the U.S., which we began recovering in July 2009, may continue growing for 5 years or more, making it the longest period of expansion. The S&P closed at a record 2003 last week. Remember that number, 2000, and check out the S&P as we move forward. We'll talk about that more, but let's go into the details here. There have been 3 rounds of stimulus that have helped spur the growth in the world's largest economy. The S&P almost tripled from its low in March 2009, sending the value of all U.S. shares to a record $23.9 trillion on August 26. A report showed last week that gross domestic product rose in the second quarter more than forecast, which pushed the largest gain in the U.S. business investment in more than 2 years. Now, we look at their equity strategist, and that would be Adam Parker. He is quoted as saying, "Equities should benefit from a scenario where the probability of a cycle peak remains low for some time." And the chief economist, Ellen Zenters, is writing that as the prolonged expansion becomes more visible, we'd expect a materially higher U.S. stock market. I'm going to suggest that we take a page out of the U.S. military. Trust but verify. Morgan Stanley is a great company, very large. However, when you're in the pattern of selling things like stocks, it's sometimes that we're seeing you sell what it is you have to sell. And what we want to look for are the fundamentals. What we want to look for is not just accept the headlines, but let's look under the hood to see if there's really something here or if it's just poppycock. I suggest that it might be poppycock. You know, they're basing their expectation on the governments around the world continuing to print money. This has never happened before. This is unprecedented. I don't think it can continue forever. What do you think is more important? At some point, I think it's got to end. I don't know what the event might be, but I think at some point quantitative easing has to come to an end. At that point, who's going to fill in the blanks with $40 billion of government money that the government is buying? Who's going to fill up that absence or that vacancy, if you will? I don't see anybody standing in line. But let's look back a little bit. On March 2nd, 2009, the S&P 500 closed at 683. As of July 13, 2011, it was closed at 1345, so that would be a double. And then just on August 25th, 2014, we see that we were at 2003. That would be a triple. To get to 2000 to 3000 from 2009 means a 4-fold increase. Now, I'm going to suggest that you don't just buy all trees grow to the sky. And you also don't look at the average and then say, let's look at the average and hope that we do better than that. I'm going to suggest that you do what our engineers have us do professionally, and that's look at the worst case scenario and then see if you can survive that. Because if you can survive that, you'll be fine. It probably won't be that bad. But if it's that bad, you want to be prepared. You don't want to just watch this become a statistic and be on the lose where we look at what's happened to the majority of people. We're seeing some things that we think are very strong headwinds. One of them would be, it appears that the European stocks are unraveling. We just saw this yesterday in Europe, looking at their manufacturing numbers. We see France expressed the fastest drop in activity in 15 months. Germany hit an 11-month low, and output for the entire Eurozone, which fell to a 14-month low. All right, so we're going to say that Europe is still deeply in trouble. It's fighting with everything it's got to keep its head above water, and that's just not going to stop anytime soon. When we look at our own economy, we're going to identify 3 macroeconomic headwinds for you again. We've touched on these before. They are the 39-year generational spending wave, the 36-year geopolitical cycle, the 45-year innovation cycle. Why are these cycles important? 2 things. One, our economy really operates based on watching what people do, ordinary people, like Homer Simpson, okay? We're consumers. It's 70% of the economy. Watch the consumer. Are they spending or are they spending? Saving. And then secondly, what's the behavior of some of the cycles? Just like your heart, okay? Getting an EKG. We've got to see the peaks and the valleys. They're always going to occur, but what the governments would want you to believe is that they have the capacity to come into a room, set the thermostat, and forget it. The machines will take care of everything. They'll take all the pain out of the equation. Everything will be just fine. Except, we're going to suggest, life gets in the way, and there's no machine that you can out-engineer life with, okay? That's just the real world. So let's look at some real numbers. Let's suppose you have $1 million, and let's hope Morgan Stanley is correct, that we see a 50% increase. And let's suppose you're trying to prepare for retirement, and you're happy with a 4% yield on $1 million, which would be $40,000 out 12 months from now. That would supplement your income with Social Security and your pension. You're fine. And then let's say they're right. So now your $1 million in the next 5 years or so goes up by 50%. That means $1 million now is worth $1.5 million. Keeping that withdrawal speed limit at the same 4% would mean that you have an income of what? $60,000 a year. 50% increase from 40 to 60. This is good. However, let's look at the worst case scenario. Let's suppose your $1 million, your life savings drops to $500,000. Let's even be more ridiculous. Let's suppose we see an 80% loss. That takes your $1 million down to $200,000. How you doing? Doesn't seem like fun to me either. If you had $1 million and now you have $500,000 and you must take out $40,000 a year, let's see, if your account's at $500,000, you might have, 12 years or so before your account's at zero? Oh, and you're still here. Are we having fun yet? Let's be more ridiculous. Let's suppose we get down to $200,000. 80% drop from $1 million down to $200,000. Can you even imagine? And you're still having to take out 4% per year. So that gives us that 5 years or so. Are we having fun yet? And we're still here, except we don't have any money. Doesn't sound like much fun to me. And then we just came across this from Gallup. 60% of Americans said their number one financial concern was not having enough money for retirement. So folks, I'm just going to suggest to you, be careful of the Kool-Aid. Do your own math. Do your own numbers. Look at the worst case scenario as you think it might get, and then see how you might prepare so that you can survive to tell the story, as opposed to be a statistic in the news. With that, the Money Doctor is out.